All right, this is a review for the midterm part two. As mentioned yesterday, the part one was mostly what you need to concentrate on in order to study for the midterm. Now we'll just do a couple of problems that might show up on the exam, and that will also help you to get familiar with the verbiage that will be used on the exam. So, for clarity and simplicity, I will redo the exercise that we did at the end of part one. And this exercise goes something like this. If you have a company and the company has an operating cash flow of we'll use new numbers that will be clear, and I'll explain along the way. We say we have a company that has an operating cash flow. OCF stands for operating cash flow of $48,000. And this company has a depreciation on their income statement, depreciation of $6,000. Okay. The interest that this company paid, the interest which also can be found on the income statement, is $2,400. Okay. I'll put the rest of the information on the other side so we can have enough room to work the problem at the bottom. If the company has net payment on the debt, or also known as principal payment, right? The principal payment is how much you pay, because if you have debt, if you owe debt on like your mortgage, or you raise money in your company in the form of debt, your debt payment has two parts. One part is the interest right here, and the other part is the principal. All right, so if you've made principal payment in the order of $2,600, okay, and you've spent in fixed asset, whether you bought a big piece of equipment or you build this new building, this or all your fixed asset, and you spent $24,000 to build that new building or to purchase that piece of equipment. Again, that information will be found can be found on your balance sheet. And then you have a net working capital that decreased by $1,300. Okay, and we all know working capital is current asset minus current liability. Okay, so let me repeat the information on this. The information is your operating cash flow is $48,000, your depreciation is $6,000, interest paid is $2,400, principal payment is $2,600, fixed asset is $24,000, net working capital, which is the current asset minus current liability, decreased by $1,300. So when I say decrease, one other way to write this number would be like this. Okay, so your net working capital decreased by $1,300. So these are the information, or this is the information given to you in order to solve the problem. And then the question could be something like, what is the cash flow to stockholders? Okay, what is the cash flow to stockholders? Now, the cash flow to stockholders is money. Money's given to the stockholders after you've paid everything, after you've paid your debt, after you've purchased or built that new building, and after you paid. When I say pay your debt, it is interest and principal, and after you've taken the depreciation in consideration. So this problem, it has three parts in it. The first step, you want to calculate the cash flow from asset. Okay, and then your cash flow from asset is simply your OCF, operating cash flow, minus your net working capital, minus the amount of money you spent on fixed asset. This is simply $48,000 minus your net working capital, which was a decrease by $1,300, minus the amount of money you spent on your fixed asset. All right, so let's do this on the calculator. And again, I'm doing these problems together with you right now so that we make sure we take the time to understand exactly how it goes. 48,000 minus gives you a plus 1,300 minus 24 25,000. That is 25,300. So the cash flow from asset is 25,300. Second part of this problem, we'll have to calculate the cash flow to creditors. Okay, cash flow to creditors. Because remember, you have to pay the creditors first, and whatever is left over from creditors, from what you've spent in your fixed asset, from the deviation from net working capital, the leftover is your cash flow to stockholders. So the formula for cash flow to creditors is simply the interest paid, because you have to pay your interest on the debt, minus the amount of money that you paid on your principal, right? It's a net proceeds. So you paid 2,600 on your principal, and that will give you, sorry, this is the formula. So it's interest minus the net proceed from your debt. Net proceed from your debt, right? The reason why I said net proceed, if the company raised money in the form of debt, this number will be positive. If the money paid down, this money will be negative. This amount will be negative. All right. So this is simply 2,400 that you paid interest minus the 2,600 that you paid. That's a cash outflow. Therefore, 24 plus 26 equals something like 5,000, I believe. Yep, on the money, 5,000. Now you can calculate the cash flow to stockholders. Okay, you can calculate the cash flow to stockholders. This is simply the cash flow from asset minus the cash flow to creditors. Okay, and this will be 25,300 minus 5,000, and that answer is $20,300, and this is your answer right here. All right, remember that your cash flow to stockholders can be calculated by finding the cash flow from asset, deduct that from the cash flow to creditors, and you'll be able to compute your cash flow to stockholder. Okay, this is one of the problems where I will give you all the information found on the income statement. I'll give you all the information found on your balance sheet, and then based on the information given, you'll be able to compute whether it is I'm asking for the cash flow from asset, or I'm asking for the cash flow to creditors, or I'm asking for the cash flow to stockholders. Depending on the information given, you'll be able to follow these formulas in order to compute the information that I ask you for. All right, this is problem number 1. Very straightforward problem, very easy to understand. All right, next problem. Give me a second here. I like to play with my colors to make sure that we're making the difference between problems and between our notes. All right, this is problem number 2. Okay, problem number 2 is a problem where I will be giving you, again, I'll be giving you all the information you need to compute the problem. Let's see. All right, this is a good problem to do regarding the ratios. Let's say that ABM Corp has a total debt ratio of 0.46. All right, so ABC Corp has a total debt ratio of 0.46, and the question is, what is the equity multiplier, also known as EM? What is the equity multiplier? Now, the company has a total debt ratio of 46. What is the equity multiplier? Well, we know that the formula for the equity multiplier is 1 plus the debt to equity ratio. Okay, equity ratio. Okay, so the equity multiplier is 1 plus the debt to equity ratio. And we know that the debt to equity ratio, the formula to find that is your total debt ratio over 1 minus the total debt ratio. Okay, so let's repeat that. The question tells you ABM Corp has a total debt ratio of 0.46. What is the equity multiplier? Well, we know the formula for the equity multiplier is 1 plus the debt to equity ratio. Debt, be careful here. Your debt to equity ratio is very different from your total debt ratio. Two different things, okay? Your debt to equity ratio is different from the total debt ratio. All right, so the formula for debt to equity ratio is your total debt ratio over 1 minus the total debt ratio. All right, so let's compute that. It is 0.46 over 1 minus 0.46, and that will give you 0.85. Therefore, your equity multiplier is 1 plus 0.85. So your equity multiplier is 1.85. That simple. That's why I'm telling you guys it is very important to know your formulas, right? Write them down and be able to make the connection between two formulas. Make the connection when you have one piece of the whatever information that's given to you. By having the formula readily available, you'll be able to calculate multiple steps in order to come up with the right answer. All right, simple as that. Next problem. Problem number 3. This is a very good one where having the DuPont identity chart right next to you will help you calculate the right answer. Remember in the first video I showed you guys a very easy way to use the DuPont identity to calculate return on equity or return on asset. Let's try this example. This is XYZ firm. XYZ firm has sales. I'm not going to write the whole thing. I'll just write informations that are important. So XYZ is the firm. The sales for XYZ are $150,000 in sales. Again, found on your income statement. Okay. The quick ratio for XYZ. Quick ratio for XYZ. I'm sorry. Wrong information. Okay, sales are 150,000. Total asset for XYZ is 300,000. Okay, total debt is 100,000. Okay, and the profit margin is 2%. All right. Now the question is asking you to find the return on equity. ROE. What is the return on equity based on the information you have? Well, if you look at the DuPont identity chart, I will write it here. DuPont chart. If you look at the DuPont chart, based on the information given, how do you find the return on equity? Well, based on the DuPont chart, the return on equity is simply your profit margin, right, times sales all over total asset minus total debt. Simple as that. So it's your profit margin times your total sales over your total asset minus your total debt. All right, so that is 150,000 times 0.02 over 300,000 minus 100,000. All right, so 150,000 times 0.02. Second, that would be something like 30,000, 0.02 times 150. 3,000 over 200,000 equal 3,000 over 200,000. It's 1.5%. All right. Or I should say the result of that equation is 0.015 or 1.5%. And that's the way you should solve for this problem. As easy as that. Okay, so XYZ firm has sales of 150 grand, total asset of 300,000, total debt of 100,000, profit margin of 2%. What is the return on equity? Well, if you go to your DuPont chart, you will realize that your return on equity is simply your profit margin times your sales over a total asset minus your total debt. And if you compute that, you will get 1.5% for your ROE. So ROE equals to 1.5%. All right, as easy as that. Let's do another problem. Another problem that is a bit challenging, that has multiple steps to it, and that includes a couple elements on your balance sheet, a couple elements on your income statement, and multiple steps, so that you guys know exactly how to compute this problem. Right, we did this already. All right, let's do one with both your balance sheet and your income statement. Cars. All right, there's another one that is fairly simple. This one says ABC firm, okay? ABC firm has a net working capital of $650. Okay? Net working capital $650, long-term debt of $4,000, long-term debt of $4,000, total asset of $6,000, okay? And fixed asset, remember, fixed asset is the amount of money you spend on a heavy piece of equipment or a new building, $3,000. So we'll say this is a piece of equipment because I doubt that you'll be able to build a brand new building for $3,000. Wouldn't you agree? Of course. All right, so the question is, you have your net working capital, you have your long-term debt, you have your total asset, you have your fixed asset. The question asks you, what is the total liability? So you have to compute for total liability. What is your total liabilities for this example? Well, first thing we want to know, first thing we want to think about when we see this problem is, all right, total liability, which financial statement is that going to be found on? Well, total liability will be on your balance sheet, right? Liability and assets are on your balance sheet. They're both balance sheet items. And what is the balance sheet identity formula? It says that all your assets will equal to your liability plus your equity, right? Asset equals liability plus equity. Always the right side will always equal to the left side, right? Because you'll raise money in the form of liability, right? Your debt or equity from your shareholders, and that money will be used to purchase the asset, right? And the asset will hopefully generate enough income to pay the investors in the bank that had lent you some money. All right, that's the reason why your asset will always equal to your liability plus your equity. Let me repeat that equation because it's very important. Sometimes, even in the master's program, I have students submitting financial statements like balance sheet that are not balanced. So why do we say that your left side of the balance sheet needs to be equal to your right side of the balance sheet? Simple. So asset equals to liability plus equity, right? Two ways of raising money in a company, either with liability, your debt, or equity, the money given to you in form of equity. So your stockholders, your shareholders, okay? And these monies, both liability and equity, will be used to purchase the asset that will hopefully, based on your projections, make enough money to pay back the debt, right? The liability, the bank holder, or pay dividends to the stockholder, the shareholder of the company. That's why liability plus equity always equals to your assets. All right. So based on the information given, how are we going to calculate your total liability? All right. So a couple of steps here. First of all, you need to find out what your current asset is. So current asset. How do you calculate the current asset? Well, you know that you have your total asset, right? And you have the amount of your fixed asset. So it's very easy to come up with your current asset, because your current asset, your total asset, let me write it this way. Your total asset is your current asset plus your fixed asset. Well, if you have the amount of your total asset and you have how much you spend on your fixed asset, well, this minus this equals to that. Simple as that. So your current asset equals to your total asset minus your fixed asset. As simple as that, based on this equation. I'll repeat that again. When you look at your balance sheet, the asset side of your balance sheet, right? Current asset plus your fixed asset equal to your total asset. Well, if you have your total asset, which is here, and you have your fixed asset, which is here, in order to find the current asset, you do your total asset minus the fixed asset. So your current asset is 6,000 minus 3,000 equals 3,000. Now you have your current asset, all right? Keep in mind, always keep in mind this equation, and you'll see exactly how it circles back around, all right? Let's keep moving. Step 2 is to find out your current liability. Current liability. Okay, current liability. Now you know that total asset has to equal to liability plus equity. Okay, now you know also that based on the information given, you have your net working capital, which is a key information. And how do you find your net working capital? Is current asset minus current liability. Current asset minus current liability equals to your net working capital. So in order to find your current liability, just take your current asset, your 3,000, minus your net working capital, 650, right? 2,000 minus 650, that's 1,350. Now you can calculate your total liability. Total liability Your total liability is simply your current liability, right? Current liability plus your long-term debt. So your current liability is $1,350. Your long-term debt was $4,000. It's your long-term debt here. That's $5,350. $5,350, that's your total liability. Okay, so this is a straightforward example where you're given some information from the balance sheet, and by applying the equation of a balance sheet, the balance sheet identity, it's called asset equal liability plus equity, you're able to, based on this information, you're able to calculate and make sure that your balance sheet balances. All right, so current asset plus fixed asset equals to total asset. Current liability plus long-term debt equals to total liability. All right, and then you can calculate the numbers missing in between in order to complete your equation. First step is to find your current asset. Once you find the current asset, you'll be able to calculate your current liability because you're given the net working capital, and the formula for your net working capital is current asset minus current liability. So if you have the current asset, you have the net working capital, you'll be able to calculate the current liability easily. Once you find out the current liability plus long-term debt will give you total liability, and as easy as that. Current liability plus long-term debt equals the total liability, and you've solved the problem. And as I said, guys, I'm always here if you have additional questions about any of these problems or any of the problems that you're working on. I'll be able to either send you an email with additional information, or if I get a lot of questions about the same problems, I'll do a small video to clarify everything that, all the questions that you guys are asking. Okie doke. Now let's do another problem. Mostly let's talk about structure of the income statement, because you'll have multiple questions about the income statement. Let's start with that. All right, so what is the structure of the income statement? First, you start with the revenues. Make this a little thinner. There you go. First, you start with the revenues, okay? Total sales. It could be revenues or sales, same thing. Then you back out the cost of goods sold, the COGS. That will give you gross profit. Okay, that will give you a gross profit. Now, from your gross profit, you will back out your SG&A. Your R&D, research and development. Also your depreciation. Okay. Once you find your gross profit, you back out your SG&A, your research and development, your depreciation, you will get your earnings before interest and taxes. From that, or also known as EBIT, EBIT, earning before interest and taxes. All right. EBIT for EBIT. All right. Now you will remove your interest payments from your EBIT, interest payment. Earning before taxes, you'll back out your taxes, and that will give you your net income. All right. So this is mostly the structure of an income statement. You have your revenues, all right, or total sales. You back out your cost of goods sold. That will give you a gross profit. Your gross profit, you back out your SG&A, your research and development, your depreciation, that will give your earnings before interest and taxes, or your EBIT. You take out your interest payments, that will give you your earnings before taxes. You back out your taxes, and you're left with your net income. All right. So if you want to look at the income statement in the form of a formula, this is how it goes. So your gross profit is simply your sales minus your cost of goods sold. All right. Gross profit is your sales minus your cost of goods sold. Your operating profit is your gross profit minus your SG&A. Okay, so it's your gross profit minus your SG&A. And your net income is simply your sales minus all of the expenses. When I say all the expenses, I'm talking about your cost of goods sold. I'm talking about these expenses here. I'm talking about taxes. I'm talking about interest payment. All of these are all of your expenses. All of your expenses is your interest payment, your tax payment, depreciation, SG&A, and R&D, and your cost of goods sold. So if you take your revenues, you back out all of the expenses, you will have your net income left over. All right, as simple as that. Now let's look at the balance sheet. Let's look at the balance sheet, which is another very important financial statement in finance. All right, balance sheet. As I mentioned moments ago, the most important equation when it comes to financial statements is the one of the balance sheet, where your asset equals to your liability plus equity. All right, left side, right side. All right, so your current asset, as mentioned moments ago, your current asset will be cash. It'll be inventory. It'll be accounts receivable, listed in order of liquidity. And your non-current asset will be your PP&E, also known as fixed asset. Okay, this is all the money you spent on equipment or plant, right? If you purchased a big piece of equipment, or if you built a brand new building or purchased a new building, this is the category where you'll find those numbers. All right, so current asset plus non-current asset will give you your total asset. All right, this is the left side of the equation. Now the right side, you have your liabilities. You have your current liability. Your current liability will be your notes payable. Okay, it'll have your accounts payable, and it'll have your salaries, so forth and so on. And in your long-term or your non-current liability, you'll have your long-term debt. All right, now if your current liability plus your long-term liability, it'll give you your total liability. At the bottom, you'll have your equity, stockholders' equity, and that will be stocks, and that will be your retained earnings. All right, so this side equals to this plus this. All right, let me change colors to make sure you guys understand. This is the left side, liability. Liability plus equity. This is your total asset. All right, these are the two statements that are very important. Now, when it comes to standardized financial statements, we've spoken about the common size, financial statement. Common size income statement is everything as a function of as a percentage of revenues, right? So common size income statement express every line item as a percentage of sales. So common size cost of goods sold, it will be your cost of goods sold over your sales. Common size of depreciation, it'll be your depreciation over your sales. All right. Common size taxes, it'll be your taxes over sales, or most of your taxes will be a defined rate. All right. Now, how do you compute your common size balance sheet? So your common size balance sheet, balance sheet is simply everything as a percentage of your total asset. Everything as a percentage of your total asset. So your cash will be cash over total asset. Your accounts payable will be accounts payable over total asset, and so forth and so on. All right, let me see if I can give you another example that would be kind of hard to compute. I want to give you something with present and future value, which I think is very straightforward. Let's pick up an example that I can make up right now. That's how easy it is to compute present and future value. All right, present and future value. Let's talk about the formulas first. All right, the formula for present. Let's start with future. The formula for future value is your present value times 1 plus your interest rate to the n power. All right, let's define each term. Let's define each term to make sure everybody's on the same page. Your FV stands for future value. Your PV stands for present value. Your I stands for interest, and your N stands for number of period. I say number of period as opposed to number of years because it could be years, it could be months, it could be weeks, it could be whatever the term is for number of period is for the example given to you. So let me try to find an example, or I'll just make up one right now. I think we'll go. I can make up one right now. I don't have. Okay, let's make up an example right now when it comes to present and future value. All right, so future value is present value times 1 plus I to the n power. Therefore, present value is your future value divided by 1 plus your I to the n power. Okay, as simple as that. So let's say that we want to find the future value. Let's say that you deposit today you deposit $1,000 in the savings account. That pays you 3% yearly. 3% yearly. What is the amount after 10 years? Compounded annually. Okay? What is the amount after 10 years? After 10 years, that's in the future, right there, future. So if I'm reading this example myself, all right, I'm picking out the important information before I compute anything. So it says you deposit $1,000 today, right? You deposit present tense $1,000. So that tells me that the present value is $1,000 in the savings account that pays 3% yearly. All right, I'm getting 3% yearly. Okay. What is the amount after 10 years? So it takes me 10 years. The number of period is 10 years, right? Compounded annually. That's perfect. In the question is asking me for the future value. By the way, these are the keys that you would hit on your calculator to solve this problem. Now, if you don't want to use the calculator, you want to be like me who does it manually, I will put out the formula. Or first of all, this is what I always do. I always trace a graph, all right? So my graph goes a little something like this. Today, I deposit $1,000. The length of that period is my N equals 10 years, all right? I'm receiving 3% every year. And what is my value after 10 years, all right? So I'm saying my future value equals to 1,000 times 1 plus 3% to the 10th power. This is what I will need to compute in order to find the future value. I will do it right now. So 1.01 plus 3% is 1.03 to the 10th power times 1,000. 10 years, $1,000 at 3% will give me $1,343.91. And this will be the future value. If I put $1,000 today, 3% a year, after 10 years, that's the money I will receive. So it's 1 plus 0.03%, 1 plus 3% raised to the 10th power times 1,000 equals $1,343.91. All right, that would be the right answer. Now, what about if that account was paying 3% semi-annually? Semi-annually. So it's making that payment twice a year. It's making that payment twice a year. I'm getting 3% twice a year. All right. So a couple things will happen here. Number one, my number of period will double. All right. Let's use another color for that to make sure that you guys see the nuance. All right. So I'll write semi-annually in a different color. Semi-annually. All right. So a couple things will happen. Number one, my N will double because I'm getting paid twice a year, and my interest will be cut in half because I'm getting 3% yearly but paid semi-annually. Okay, so here for this problem, my number of period will be 20. My interest will be 1.5%. This formula will now be 1 plus 1.5% to the 20th power, and that changes my answer. So let's do it together. 1.5% is 0.015 plus 1 equals 1.015 to the 20th power times 1,000. The future value for this example is $1,346.85. All right, that's if you were getting paid semi-annually. Now, that same account will pay you. That same account will pay you quarterly. That same account will pay you quarterly. All right. So two things will happen. Your number of periods will quadruple, and your interest will be cut by 4. All right. So your number of period will be 10 times 4, which is your 40, and your interest will be 3% divided by 4. You have to rewrite this. It'll be 1 plus 3% divided by 4 to the 40th power. You can quickly calculate this. 3 divided by 4 is 0.75. 0.75% is 0.0075. 2 plus 1 is 1.0075 to the 40th power is 1.3483 times 1,000. and your payment quarterly, if you get paid quarterly, will be $348.35. All right, so you can see the difference between getting paid quarterly, semi-annually, or annually. Please be sure to pay attention to your number of periods and pay attention to your interest also, because it will make a big difference in your answer, and that will be the difference between you getting the answer right or getting 0 for that particular problem. Trying to think of another problem to give you. So these are the formulas that I want you to add again to your formula sheet. Your ROA, and that's all based on the DuPont. Your ROA goes to your profit margin times sales over total asset. Okay. Your return on equity equals to your profit margins times sales over your total asset times 1 minus your debt ratio. Okay, make sure you write that down. That's very important. Okay. Your equity multiplier equals to 1 plus your debt to equity ratio. Okay, and then your debt to equity ratio formula for this, for your debt to equity ratio, we did an example on this moments ago, is your total debt ratio over 1 minus total debt ratio. All right. What other formula that we looked at that will be very important for you to solve this midterm, to solve all the problems in this midterm? Well, I think these are the couple formulas that wasn't so clear on your slides. Remember, for the midterm, I've always said this: don't kill yourself memorizing formulas. It's better for you to know how to use the formula than to memorizing it. Memorizing it won't help you if you don't know how to utilize the formula. I'd rather you write down the formulas and understand it so that you can solve the problems. All right. The exam is very straightforward. It's fairly simple. It's everything that we've done thus far in the class. If you have your formulas in front of you, you shouldn't have any problems to solve any of the problems on the exam. One thing that I will say when it comes to calculating your present and future value, there's a huge difference between simple interest and compounded interest, and I'll make the case right now by giving you 2 examples. Well, I've given an example on your compounding. This is your compounding, right? Compound. Man, I can't write. Sorry. Let's try this. 3rd time is a charm. Compounding interest. There you go. This is your compounding interest example. For your simple interest, it will go something like this. Let's say that, let me find an example. Bear with me here. I want to find an example that will help you solve anything that may have appear on the exam. Let's say that Mr. Alex invests in a savings account $1,000 that pays him 3%. We'll say use 3% simple interest, and he wants to know what's his amount after 10 years. Okay, so the difference between the compounding and the simple interest would be, future value would be 1,000 times 3% times 10. plus 1,000. That's the whole formula, plus the principal, 1,000. So here, the future value would be $1,300. Okay, that would be his future value, the future value of his investment if he leaves it on this account for 10 years and the account is paying simple interest as opposed to compounding. Okay, simple interest is this. Remember, compounding future value for this would say Alex invests in the savings account $1,000 that pays him 3% compounded annually, and after 10 years, what is his future value? After 10 years, his future value is 1,000 times 1 plus your interest to the n power. So it would be 1,000, 1.03 to the 10th power, right? So it would be 1.03 to the 10th power times 1,000, 1343.91. Okay, I know what most of you are saying is that, well, the difference between the simple and compounding is only $43.91. But remember, here we're only talking about $1,000. What about if that was $1 million? That would be quite some change. So it's very important to know the difference between simple interest and compounding. Okay. That concludes the review session with some of the problems that I think that you guys may find in your midterm. After reviewing the part 1 and part 2, if you have any additional questions, please let us know. Remember that the exam is due on the date listed on the syllabus at 11:59 p.m. No extensions, please. Give yourself about 2 hours to complete the exam. If I were you, I would start the latest on the date listed on the syllabus around 7:30 that night. That way you have more than enough time to complete the exam and submit it on time. Thank you very much.